Welcome back to CWM University, where we learn together. And my last video, we talked about ETFs and how they allow you to invest in dozens, hundreds, and even thousands of companies with a single purchase. But ETFs aren't the only way to do that. Today, we're going to talk about mutual funds, what they are, how they work, how they're different from ETFs, and some common mistakes that beginners make when choosing between the two. By the end of this video, you'll know the difference between an ETF and mutual fund, and you'll be able to decide which one fits your lifestyle the best.
I am not a financial advisor, and this is just practical guidance. Viewer discretion is advised.
A mutual fund is a pool of money from many investors that is managed by a professional fund manager. Instead of buying individual stock yourself, the fund manager decides what investments to buy and sell in that mutual fund. With an ETF, you're usually buying a basket of stock that follow a specific index. Think about it like hiring a coach to manage a team for you. With a mutual fund, there may be active decisions being made behind the scenes. Just like an ETF, mutual funds can hold dozens, hundreds, and thousands of investments. A mutual fund can invest in stocks, bonds, international companies, real estate, dividend paying companies, just like an ETF. And you can find both in retirement accounts such as a 401k and a Roth IRA. Now, the big difference between an ETF and a mutual fund is how they trade. ETFs trade throughout the day like stock. Their price can go up and down and fluctuate throughout the day, just like a stock does. Mutual funds trade once a day after the market closes. Everyone buying or selling that day receives the same closing price. If you want to know more in depth about an ETF, you can check out this video right here that I recorded previously about ETFs. Another difference is how they're managed. Most popular ETFs track an index. For example, the S&P, the total stock market, or the NASDAQ 100. Many mutual funds are actively managed. That means a manager or a team is trying to outperform the market. Sometimes they succeed, and sometimes they don't. Also, the fees look a little different. ETFs usually have lower fees, but mutual funds range from a low percentage to could be possibly a high percentage. A higher fee doesn't automatically mean it's a better investment. So let's look at some differences in those expense ratio fees and why they would matter in the long run.
Let's say two people invested $100,000 and both earned the same market return over the next 30 years. The only difference is the fee that they're paying. One investor pays 0.03% per year, and the other investor pays 1% per year. I'm going to show you how to figure out which person will earn the most money based on the expense ratio they're paying. I found this mutual fund calculator on NerdWallet. Get on there, you can scroll down. So the initial investment amount, we said $100,000. The years that they're gonna have it in there is 30. And for the first person, the expense ratio is 0.03%. Future plan contributions, we'll put 0 for the future plan contributions. And then the rate of return, we're gonna say 8%, because the stock market usually gives you around 8% return on your money. So we're gonna calculate. So the first person, at the end of their 30 years, they will end up with $997,913.83. And their fees that they will end up paying would be $8,351.86. So the money they get to take home is here. That's the first person. The second person, the only difference is their expense ratio was 1%. So let's see how that changes things. Calculate. They would end up with $761,225.50. And the fees that they will pay, $245,040.19. You know what I could do with that money? That's a lot. The difference between the first person who had a 0.03% per year expense ratio and the person that had a 1% expense ratio is $237,000. That's a whole house, depending on where you live in the country. That's a lot of money. So a lower cost mutual fund will be helpful in the long run than one that has a higher expense ratio. This doesn't mean automatically that the mutual fund with the higher expense ratio is bad, but it does show why understanding those expense ratio fees is important.
Another difference between an ETF and a mutual fund is the minimum investments. For an ETF, you can usually buy shares of that ETF. Some ETFs allow you to buy fractional shares. But on the other hand, some mutual funds require a minimum investment, sometimes $500, $1,000, $3,000, or even more. Just depends on which fund company you decide to go with. Also, when it comes to taxes, because we all love taxes, ETFs are usually considered more tax efficient than mutual funds. In the category of automation, this is when a mutual fund gets the shine. Mutual funds are often very easy to automate. You can invest every paycheck, every week, once a month without worrying about buying whole shares. So now we've come to the time where I think it's time for us to look at some mutual funds.
I'm going to use the ones I found on Bankrate. You can get on Google and just type in best mutual funds for 2026 and then click on whatever website you choose. So we're going to go down and look at the best mutual funds. So we have best equity mutual funds, top US index mutual funds, and they have their year-to-date performance, their 5-year performance, and their expense ratio, which we want to know because we just saw what we saw earlier with the example, why that matters. And then of course, we have like Vanguard 500 index. The ticker symbol is VFIAX. And then you also have one that's Schwab S&P 500 index, and the ticker symbol is SWPPX. And then of course you can scroll down. They have some that are international index funds. They give you the top mutual funds that they have. They give you year-to-date, 5-year, and expense ratio. So these are some ways you can just start there just to pick which one you want to read and learn about. Next, we're going to look up a U.S. index mutual fund. And we're going to start with SWPPX. So we're going to go to Google and go to Yahoo Finance and search up the ticker symbol SWPPX. And then we're going to read on it. It said that it closed at $19.01. If you want to buy this mutual fund, it'll be $19.01. And then its year-to-date return is 11.23%. Also, you can find its expense ratio, and it says its expense ratio is 0%. Even better. Then, of course, up here, you can go into what it looked like for that month, for the 3 months. We can even go to 5 years. We want to see how is it performing over the course of time. Is it going up? Is it going down? If it goes down, does it self-correct? So you can see right here, it went down a little bit, but then it went back up. Went down a little bit, went back up. So just look at the data and see what the data shows you. You can also scroll down and it will tell you the performance overview year to date, if it's been in the positive, 1 year, 3 years, 5 years, what it's been performing over that course of time. Then you scroll down some more and you can see the top 10 holdings in this mutual fund. So you have all of these, and it tells you what percentage of that is in the mutual fund. And then, of course, you can see the sector weightings. So this mutual fund seems to be heavy in technology. It is 35.60%, but it also has some other sectors in it as well, like finance, healthcare, energy, real estate. So these are some things you want to know what those mutual funds are invested in, what's the percentage of each thing, so you can make a more informed decision on which one to pick. The next mutual fund we're going to look up is a top dividend mutual fund. If you watch the ETF video, you remember that dividends are like a thank you for investing in these funds. So let's look up a top dividend mutual fund. Okay, we're going to type in VDADX and look into that one. So VDADX is Vanguard Dividend Appreciation Index Fund. Ticker symbol is VDADX. So right now it says at the close, it was $63.31. The return for the year is 7.17%. You can't get that in a high yield savings account. You can't get that in a CD, not the ones that I've seen. So that's pretty good return on your money. The expense ratio is a little high, 0.74%. And then of course you can go through here and look at the 5-year to date. It seems to be trending upward. 10-year, it's like it's always been trending upward. You scroll down and see what are some things that are in here. So top 10 holdings in the company, you can see all of those. And let's see what it's heavy in. This mutual fund, it says that it has 26% in technology and then about 20% in finances. So technology and finances seem to be neck and neck, about the same percentage of weight. It does have a lot of healthcare, 16%. And then you can just look at all the percentages of what sectors it has in this mutual fund. As always, I cannot confirm or deny if I am invested in either of these mutual funds that I showed you. Google is free. Start off with just Googling the best mutual funds for whatever year it currently is when you're watching this video. And after you do that, then go search them on Yahoo Finance and look at the details, look at the trends over a period of time, year to date, 5 year, 10 year, and then see what is actually inside of that mutual fund. Because you want to try not to have mutual funds that overlap with the same companies if possible, or if that's something that you want to do. After you look at the data, then you make the decision what's best for you.
Common mistakes beginners make with mutual funds. One, they chase performance. They saw that it was on a run and they decide, I want that mutual fund. Just because it's running now doesn't mean it's going to continue to run. Check the data. Look how it performed over a long period of time, then make your decision. Next mistake. A lot of people want to ignore those fees, those expense ratios for some reason. Higher fees can eat into your returns over time. And we don't want any fee eating into our profits. We want all the money in our pocket, or at least the most that we can have possible. Next mistake, people are not understanding the fund because they're not researching it and seeing what's inside the fund, who owns the fund, what's the strategies, and what's the risk. Always do your research before investing in anything. Google is free. And then some people own mutual funds that have overlapping in what they own. So just like an ETF, if I buy an ETF that has a lot of technology in it, and I buy another ETF that has a lot of technology in it, I'm probably owning some of the same companies. So it's the same concept with mutual funds. You may accidentally buy several mutual funds that have the same companies in it. That's why it's important to do your research and see what is inside of that mutual fund. Now you may want to ask, which one is better? The truth is, neither one is automatically better. Some investors prefer ETFs because of their lower cost and flexibility. Others prefer mutual funds because of automatic investing and professional management. The best choice depends on your goals, your risk tolerance, your investing styles, and your account type. Also, if you are interested in learning how to find companies that have brokerage accounts, you can watch my ETF video where I go more into depth about how to find those brokerage accounts. If you watch both my ETF video and this mutual fund video, you now understand the two most common investment vehicles available to everyday investors. Remember, the most important thing isn't picking the perfect ETF or the perfect mutual fund. It's about consistently investing, continuing to learn about how to grow your money. And don't forget, the more money you have, the more options you have. In the next video, we're going to talk about Roth IRAs and how we can use ETFs and mutual funds to grow our money in a Roth IRA. Let me know in the comments, do you prefer ETFs or mutual funds? And let me know why. If this video was helpful, give it a thumbs up, share it with somebody that you know it can help. If you haven't subscribed, go ahead and press the subscribe button and join the university. Thank you so much for taking out your time to watch this video. And you already know, until next time.